What if your richest decade was decided the day you were born? Not by fate, but by how you invest at 20, 30, 40, 60. A single year of delay can erase a decade of comfort. The candles are lit. Do you buy time or watch it burn? This is a story where the main character is time. It compounds quietly, multiplies relentlessly, and punishes hesitation. Your age isn't just a number. It's a map for risk, resilience, and reward. Every chapter demands a different playbook and a different courage. Start at 22 with small sums, and time becomes your co-founder. Wait until 32, and you must double, even triple the effort for the same end. Markets are loud. Compounding is quiet. The quiet wins, if you begin early enough to hear it. In your 20s, your greatest asset isn't money. It's human capital, the decades of earnings power still ahead. That future acts like a bond, letting your portfolio tilt boldly toward growth. But bold is not reckless. First build an emergency moat, then charge. Debt with double-digit interest devours dreams faster than markets can feed them. Crush it. 3 to 6 months of expenses, parked safe, turns chaos into inconvenience. Only then does risk pay. A fortress of cash is not idle. It's your permission slip to own volatility.
Fees look harmless, like pebbles in a shoe. Walk decades and they blister wealth. Automate investments. Favor broad, low-cost index funds. Let rebalancing be mechanical, not emotional. The fewer levers you pull, the fewer traps you spring. In your 20s, invest in skills like an angel investor backs founders. Certifications, coding, languages, negotiation, these widen paychecks and shrink risk. Capture employer matches. Keep costs Spartan. The goal isn't rich next year. It's unshakable 10 years from now. When markets lurch downward, the 20s investor is paid in discounts. Volatility feels like an earthquake. Think of it as gravity for prices. Automate buys through the tremors. The habit is the hero. Future you will thank present you for being stubborn. Your 30s arrive with new variables. Mortgages, childcare, promotions, fatigue. Risk still belongs, but guardrails rise. Insurance shifts from optional to essential. The portfolio grows roots, your life grows branches. Balance returns with sleep at night risk. Target date funds can be a quiet autopilot in your 30s, gradually easing risk as the finish line approaches. Or build your own mix. Global stocks, quality bonds, and a cash slice for surprise storms. Whichever you choose, choose it on purpose. The small, boring ritual that harvests discipline. Annually or on bands, you trim the winners and feed the laggards. It feels wrong. That's the point. Process over feelings turns markets' mood swings into your steady metronome.
In your 40s, the middle game tightens. Parents age. Kids need more. Careers peak or plateau. Catch-up contributions aren't optional. They're a sprint to close the gap. Avoid lifestyle creep. Raises should lift savings rates, not just restaurant receipts. Health becomes a balance sheet item. Build reserves for medical surprises. If your country offers tax-advantaged health savings, use them ruthlessly. Protect income with disability coverage. The best portfolio can't outrun a derailed paycheck. Own a business? Beware concentration. Your salary, pride, and portfolio may all ride the same horse. Hedge with broad funds outside the venture. If storms hit, you need ballast that isn't tied to your roof. In your 50s, risk isn't the enemy. Running out of money is. But sequence matters now. Begin building a bond ladder or cash buffer. Consider partial annuities for a paycheck you can't outlive. You're engineering resilience, not chasing headlines. Live a trial year as if retired. Track every expense. Test your withdrawal rate through a simulated bear market. Discover leaks while fixes are cheap. Better to rehearse fear than improvise it. College or retirement? Air masks go on you first. Fund education to your values, but don't mortgage elder peace for a diploma. Dedicated education savings help, yet retirement cannot borrow from the future at favorable terms. Approach your 60s like a pilot scanning instruments. Pensions,
benefits, savings, debts, health, purpose. Optimize claim timing if systems allow. Blend guaranteed income with flexible assets. Glide, don't dive.
Bad returns early in retirement can sink an otherwise solid plan. Enter the bucket strategy. Cash for 1 to 2 years, bonds for near term, stocks for long-term growth. You draw from calm waters when seas rage. Inflation is the slow thief. Protect the future with assets that breathe with prices. Equities, real estate, inflation-linked bonds, skills that command premium wages. Your spending plan must grow, not just endure. Your 70s introduce required withdrawals in many systems. Turn them into design, not dread. Time charitable gifts, refill your cash bucket, rebalance without tax shock where possible. Wealth now is freedom, not scorekeeping. Tax location beats clever stock picks. Place growth where it compounds untaxed longest. Park income-generating assets where taxes are deferred or muted. Different accounts, same household. You're composing a symphony, not a solo. Insurance, wills, powers of attorney, dry words, living consequences. One document can save months of confusion. Write letters of instruction. Your plan is not complete until the people you love can find the map in the dark. The market is a mirror. Fear shows when prices fall. Greed whispers when they rise. Pre-commit rules. Savings rate, rebalancing bands, no trade windows. Write an investment policy statement. Your calm voice in a storm you haven't met yet. Bubbles expand belief. Crashes compress patience. 2000, 2008, 2020, different villains, same plot. Those who had plans endured. Those who chased headlines became headlines. Markets reward behavior more than brilliance. Real estate can anchor or drown. Buy when stability, not envy, drives the decision. Budget for roofs, pipes, and taxes that rise quietly. Renting is not failure. It's a hedge against roots before you grow them. Alternatives glitter. Private deals, commodities, crypto, art. Proceed with bite-sized positions, clear theses, and exit rules. If you cannot explain the risk in one sentence, you cannot own it through a headline. A bear market growls. Portfolio down 30%. Your 60s self stares at 2 buttons. Sell to sleep or follow the bucket plan and spend from cash. The clock ticks. The plan blinks. You already trained for this. Hold. Rebalance. Live. Legacy is built daily. Teach kids to invest early. Automate gifts to causes you believe in. Set beneficiaries. Update them. Wealth is a story you inherit and rewrite. Make your chapter generous, legible, and durable. So, what if your age is not a limit, but a lens? In your 20s, you plant. 30s, you prune. 40s, you fortify. 50s, you rehearse. 60s, you glide. 70s, you give shape. Time is the market. The question returns, will you buy it or watch it burn?